If you're a high earner, you probably already know that the IRS puts an income cap on who can contribute to a Roth IRA. And if you're making six figures, chances are you're over the limit. But what if I told you there's a perfectly legal loophole that lets you still get all the benefits of a Roth IRA, even if you earn way above the IRS limit? It's called the Backdoor Roth IRA, and today I'll break down exactly how it works, step by step, in the simplest way possible, so you can take advantage of tax-free growth just like the wealthy do. And here's the best part. This strategy can save you hundreds of thousands of dollars in taxes over your lifetime. If you're not using it, you could be losing a massive chunk of your retirement savings to taxes. Let's get started. Before we dive in, let me just say, I'm just an accountant guy, not your personal financial advisor. This video is for informational purposes only, and I strongly encourage you to speak with your accountant or tax professional if you have any questions about this strategy. Now let's get back to the topic. Why high earners need a backdoor Roth IRA. Here are some reasons. You already know the Roth IRA has an income limit, but what you might not realize is that there's a completely legal way around it. If you're already maxing out your 401k, you need additional ways to invest for retirement without paying a fortune in taxes later on. Taxes will likely be higher in the future, and a Roth IRA gives you complete control over your tax bill in retirement because your withdrawals will be 100% tax-free. And here's the kicker. Using a backdoor Roth IRA can save you hundreds of thousands of dollars in taxes over your lifetime. Let's put some numbers on this. If you contribute just $7,000 per year to a backdoor Roth IRA and let it grow at 8% per year after 30 years, you could have over $856,000 in tax-free retirement money. But if you use a traditional IRA instead, you'd owe taxes on withdrawals, leaving you with only about $642,000 after taxes. So just by using this one strategy, you could legally shield over $214,000 from taxes. That's money that stays in your pocket, not the government's. Alright, now let's break this down step by step so you can do this yourself. Step 1. Open a traditional IRA. You can open a traditional IRA at any brokerage. Fidelity, Vanguard, Schwab, you name it. This account is just a temporary holding place for your contribution. We won't be keeping money here for long. Before going to step 2, I am going to warn you right here, if you already have a traditional IRA account with pre-tax investment. You don't need to open another traditional IRA account. However, there are steps you need to take in order to avoid the pro rata rule from the IRS. I'll show you how to fix it later in this video. Without this, the backdoor Roth IRA won't work. Now let's get back to step 2, make a non-deductible contribution. Since your income is too high, your traditional IRA contribution is non-deductible, meaning you won't get a tax break for it. And the 2025 contribution limit is $7,000, $8,000 if you're 50 or older. Pro tip, do not invest this money yet, just let it sit in cash for now. This keeps the process simple and avoids any taxable gains before converting. Step 3. You should wait a few days before converting your money to your Roth IRA account. It is optional, but recommended. Some financial advisors recommend waiting a few days to avoid IRS scrutiny under the step transaction rule. This rule suggests that if you contribute and convert too quickly, the IRS might question whether you were trying to bypass Roth income limits directly. So, before converting money from your traditional IRA and Roth IRA account, you should wait for a few days to a week. It is usually enough. Step 4. Convert the traditional IRA to a Roth IRA. Now transfer your money from the traditional IRA into a Roth IRA. This is the backdoor part. Your brokerage will have an option to convert or recharacterize your traditional IRA into a Roth IRA. Tax note. Since your original contribution was after tax, You shouldn't owe any taxes on the conversion unless the money has earned investment gains while sitting in the traditional IRA. If you earned any gains, you'll owe taxes on just that amount. That's why it is recommended that you just leave your cash contribution in your traditional IRA account before converting it to your Roth IRA account. Step 5. Invest and let it grow tax-free. Now that your money is inside a Roth IRA, you can start investing in stocks, ETFs, index funds, whatever fits your retirement strategy. And the best part is that your investments will grow 100% tax-free, and you'll never owe taxes on withdrawals in retirement. If you already have a traditional IRA and think you can simply open a new one to convert funds into a Roth IRA using the Backdoor Roth IRA loophole, think again. The IRS doesn't care how many traditional IRA accounts you have. They will consider the total balance across all of them when calculating taxes. So before you proceed, here's what you need to do. You must roll any pre-tax IRA funds into a 401k before executing a backdoor Roth IRA. Once the rollover is complete, keep your traditional IRA open, even with a zero balance. This ensures you can repeat the backdoor Roth IRA process next year without complications. Again, if you contribute and convert too quickly, the IRS might question the transaction. You should wait a few days before converting to avoid the step transaction rule. In addition, lawmakers have tried to close this loophole before, but as of 2025, it's still legal. If you're eligible, start using it now before the rules change. By the way, a lot of people are uncertain whether the Roth IRA income limit is based on adjusted gross income. The answer is no, it's based on modified adjusted gross income, which is adjusted gross income plus certain add-backs that can increase your total income for IRS calculations. Okay, let me clarify. The adjusted gross income is your total taxable income minus specific deductions like 401k contributions, HSA contributions, and student loan interest, etc. Whereas modified adjusted gross income is adjusted gross income plus add-backs, like tax-exempt interest and certain deductions the IRS doesn't count for Roth IRA eligibility. In conclusion, the backdoor Roth IRA is one of the best tax loopholes high earners can use, and now you know exactly how to do it. So, are you planning to use the backdoor Roth IRA this year? Drop a comment below and let me know. And if you want to learn even more ways to legally reduce your taxes, check out this next video on Mega Backdoor Roth IRAs, where you can contribute even more tax-free money. See you there.